Hey guys, welcome to The Real Trio and thank you for watching this video. In this video, myself and Nir will be going through what the 2021 stimulus package means for America and how foreign investors should look at it in a way to understand what it means for the real estate market. If you like our videos, click the like button, hit subscribe, and we look forward to seeing you on the inside. Now, as mentioned, we have Nir with us, who is our guru when it comes to many things. But in this particular video, we'll be covering, as I mentioned, the stimulus package and what it means. Hey, Nir, how are you, buddy?
Hey, Yanni, how are you doing, my friend?
Very well. Good to hear from you again, and hope everything's good in Israel.
Yeah, things are good. I think if we touch base on your great intro, these are interesting periods. A lot of things are going, and I think it's going to be a very exciting and interesting conversation talking about the stimulus check, the market overview in the US perspective, global perspective. So I think it's a very important topic.
Yep, I think it is too, and that's why we're just quickly going to go over it. Here, I've just taken some of the bullet points of the stimulus package that got passed by the Senate and the House yesterday. And we just want to go over a few things here. There's a few key factors that as an investor, we want to ensure we look at the data and see what it means for us. There's a $30 billion rental assistance that will be given out to to tenants. And we've got to see if this is beneficial for the investors, commercial and single family. So there's a lot of information to go through, and there's a lot of information that hasn't been dissected yet. So we just want to cover a few things just to see at this point in time what we can understand from it.
Yeah. I think when we look on the bullets and make an initial observation, we can first observe that, and I think it's relevant for the US, but for additional countries, we see different countries taking the stance, which to some extent makes sense to create money, basically is create inflow of money to the market with the form of subsidies to individual or businesses as some kind of a short-term mitigation to the natural impacts on the economy and the businesses due to the COVID and these, let's say, natural circumstances or on individual and businesses not working or working less. So this is one thing that we see here in the form of what you said, for example, the $1.9 trillion. If we put it into perspective, just to understand what this number means, it's if we look on the, let's say, dollars that were printed throughout the history until today, we got into 2019 already with the non-precedence in the history for, let's say, the amount of debt. And if I recall correctly, somewhere around 40% of all money printed throughout the history was printed just in the recent 12 months. So that's to understand the perspective, how impactful what the era that we are experiencing these days is in the historical perspective. So I think that's important, going from the micro, the stimulus subsidy to the individual, which we will analyze in micro level, because on the micro level, it means that these individual or businesses, it's kind of a lifeline. It's important, but then in risk management perspective, it comes to mind to think, well, what will happen? Could the stimulus be forever? No. How would the recovery would look like? what would happen to individual or businesses that are struggling to really get back and survive in the reality? Because everyone understands that the stimulus is an intermediate form. So on the micro level, there are implications that I think worthwhile to analyze, but also on the macro level, to understand the impact of this interference on the global economy is worthwhile, and then how these two come into play together.
Exactly, and this is one of the the things that we are living in a unique time where we have low interest rates, we have the government's pumping in money into the economy. As you said, 40%. It's a very high number, and we don't know what the implications will be in the long term. Obviously, hyperinflation is possible. It has happened in history, and we're not immune to it. And we don't know what this will have. The long-term effects, the psychological part, and also the financial issues that may come with this. But the interesting thing here, in one of the key dot points here, I like to highlight is that all dependents for the filer will also qualify for the $1,400. Meaning, so the person filing for the stimulus package, if they have dependents, 3 to 4 people in their household, they can also claim their $1,400 a month check, which is quite phenomenal when you think about the loopholes that people will be able to go through to create some extra income. So this won't be a perfect system, but it is a system that's there to blanket to cover most of its economy where possible. Without, it's not going to be perfect though.
For sure. I mean, when we look into the efficiency of the program, we have to understand that this, for the stimulus to achieve its purpose, it needs to happen in a short time frame, and to dispose $1.9 trillion in short time frame. It means, to some extent, being exposed to inefficiency in the disposal of these subsidies, and there will be impacts on the market and economy, and we already see that. We see subcontractors that choose to stay at home. We see different people that they request to postpone their income, like they are willing to work, but they request to postpone their income so they can enjoy the stimulus. So we already see the impact on the macro level with that. And I think for policymakers, you have to choose where you prefer to go wrong, to be maybe strict, and people who need the money would not get that, or maybe be open so you can pour the money into the market in short time frame and be exposed to these kind of inefficiencies. So it's correct. That's for sure coming into play.
Mm-hmm. And with this, mixed with the whole forbearance on investors of eviction, what do you see happening? Will there be another stimulus package by the end of the year if COVID still continues to wreak havoc on our economies, or with the vaccine rolling out? You've had Israel's had its vaccine rollout recently in the last month, as has Australia. What are your thoughts on what this would mean for the world economy moving forward?
Well, I think if I frame it as a question, there is the question of how the recovery would look like. I think it's already becoming evident that we talk about the process. It's not that we're going to, we got into it like at a snap, but we are not. I mean, so it seems we're not going to snap out of it. It's going to be a process. And likely a process that can be measured in years, not months, and definitely not weeks. And yes, we see that in kind of, let's say, some kind of a big trial, because like in Israel, it's relatively a small country, small population, less than 10 million. We already have the majority of the population vaccinated. We still see the COVID is still here for sure, and the planning or the policy around opening up the economy is moderated. Like, okay, let's open places for social gathering or for closed places gathering, but in limited and still in limited numbers. So it's all like, trial and error. Policymakers are trying to see if we're opening, what's happening. And that might be because in Israel we are first or one of the first countries to be in this position. But I think it's kind of signaling that policymakers in general, I don't see. I see it less probable of policymakers taking a stance of snapping out. We're vaccinated, back to where we were. It's not the expected scenario. So when we think about recovery, we have to understand it's something that definitely, most probably will be to the entirety of 2021 and very probably also during 2022. And with this understanding, we need to start analyzing how different scenarios come into play with stimulus package continuation and with kinds of, I don't know if to use the word bubble, but in some extent, think about those people who are struggling. And with time, we will see those who are struggling be in more dependent situation. Like if they're getting the forbearance, it's not that they're not obligated to return their debt for the principal, the interest, the insurance, the taxes, etc. So in some sense, like they're above water, but there is and which getting deeper and deeper with the time. So that's one dynamic. And the second dynamic is that with time, we see more and more people that are getting dependent on the stimulus. So having an economy which is getting more and more dependent on the stimulus is, let's say, the increase of the bubble or the risk. Okay, we can some way measure or estimate the level of the risk looking at this, because these are people, businesses that are becoming less and less self-sustainable themselves.
Yeah, those are some great points there. And another thing that I really want to touch on as well is that there's no boost to the minimum wage. Well, I said page there, but I was going to say wage, which may benefit small businesses in hiring, because that was the issue with increasing the minimum wage was also like a double hit to small businesses that were already struggling with in the economy where we currently are in.
Well, eventually the minimum wage or wage in general is something that I think is good to analyze looking at the market, because eventually the market and the wages in general are balancing between the supply and demand of jobs. And we know that currently in terms of jobs, the unemployment is increasing. So that's obviously a limiting factor to job growth or wage growth. On the contrary, we in general expect to see decline in that. But I think another thing that is interesting is not just looking at the quantity of the salary or the job, but also looking quality-wise, because we are already seeing that there are different needs, and a lot of people, they would need to they go out of work from what they did previously, but for some of the people, they would need retraining, they would need new skills, and this would need infrastructures. I don't see that happening in a day. How are we qualifying more people for, let's say, digital related jobs, digital marketing? But, a lot of things are now happening differently. We already see that. So this is something that would come into play as well. And on the other end, when we go back to the macro level and we look on all the money that is being poured into the marketplace, this is where it is important to talk. And you mentioned the word inflation. I've been talking about it with you for the beginning of 2020. I think.
Very, very long time. Yes, we have been talking about interest rates and inflation for a long time.
Yeah, and I think it's still relevant. I think the sane, really, to be a sane and a conservative investor, not something that is a risk taker. On the contrary, is to think about allocation outside of what we call fiat. I'm not just talking about the US dollar, because we have to understand the era of globalism. Like, even if in a specific country, and by the way, it's not just the US who are printing money. There are additional countries who do the same. But we have to understand that in the era of globalism, when a giant like the US prints money in this scale, then it's not just commodities that are, let's say, can be imported or exported. Also, inflation can be imported and exported. Why? And that's important. That's very important to understand. Why is that? Because more money is coming into the US market. But where does it money go? Currency flows. That's why it's called currency, right? Currency flows. Yeah. So we are in the era of globalism, importation, exportation. So this money flows to other markets as well. More money is coming into the markets, but in terms of commodities, and we can measure that through GDP, we can do, and I think it's important, because what we are talking right now are a lot of important things about money, lessons that are not necessarily being taught in, let's say, traditional schools. And this is why I'm trying to give also the dynamic, because I think it's important for people to understand how these things come together into play. And in the market of money, because it's a global market, because it's open, this inflow of fiat, of US dollars into the US market eventually is not something specific or private to the US, but something that for sure will have impact on other countries, especially the ones that are the big countries in terms of commerce with the US, because this money will flow to those markets. And in general, when you look on the money market globally, we do not see the output, which can be measured through GDP. We do not see it grow. On the contrary, globally, we see it declining, because there are interruptions to supply, to production and supply, etc. But definitely, we don't see this now increasing the GDP. And this is, let's say, in general, the supply of goods. But on the other end, we see the demand. The demand we see, or let's say the payment capability or the money goes up. So there is more money in the market, and there is the same or less output. So this is a market as well. And where is more demand and less supply, then this is eventually, if we try to explain, this is inflation. This is why inflation happens, because the value of money goes down in this market dynamics.
Well, let's look at the US, market at the moment for real estate. There's a low inventory, and now prices are going through the roof. There's inventory is very, very low and hard, and now a house that cost $45,000 4 years ago is now worth $100,000 all of a sudden. So it's very interesting times. What are your thoughts on the current rate increase from the Fed? Only in the last couple of days, they've raised the interest rates already twice this week, I believe. So it's things are moving.
Well, I think that we talked before about the unprecedented levels of debt and the printing of money. So this money printing is served by debt. There is no way to print money without issuing debt. So there is more supply of debt, and that's a market again. So so for the demand to fulfill the supply, it impacts the interest level. But I honestly do not see a lot of probability for this dynamic to go up a lot. On the contrary, because it means the countries would need to pay more money for the debt they're issuing, and that's not their interest. So I don't see how, or I don't see that they are in a position to go dramatically to do a dramatical moves with the interest increase. On the contrary.
Interesting. Very interesting. Well, I think we covered a lot of things. We're just going to be a 20-minute video, nice and short for our viewers. Any final thoughts on this, and what your thoughts are, or have you think you're confident you've covered everything?
I think that if we try to put it in, some bullet points of observations, I think one, this is an evolving process which needs to be continually monitored. We see that in general, the dynamics are such that commodities in general and real estate specifically, known as inflation hedge, are asset classes that I think risk-avert investors should think more about allocation. The stock market, I think it's opportunity, but more volatile in these times, but also holding our life savings in what we feel are safe havens in our banks are getting more and more riskier positions. So in this sense, I think real estate in this historical period as an inflation hedge, it's, I think, a risk management allocation.
Great vehicle.
Yeah, that is making more and more sense to consider as allocation of at least part of the funds. And I think another thing that I want to put it as an important observation, because I see this from a lot of investors and clients that I'm serving. They want to learn about real estate and where is the opportunity in the deal. And I think these times show how important it is to understand, real estate eventually is a market, but there are more markets. And we talked about the money market, we mentioned the stock market, eventually all of these markets together are the economy. And I think it's very important for people to invest in themselves, to learn these basics concepts and the dynamics of how the market and economy is working, so they can keep doing educated and calculated decisions.
I agree with that. And I think that's the reason why we created this video. People may be asking, we're a real estate, investment channel. Why are we talking about the stimulus check, and why is that important? Because it's all important. The stock market's important to real estate. There's so many moving things in the engine of the market, and we need to focus on real estate, but we have to be aware of the surrounding engine parts to make the vehicle move. So I think you hit the nail on the head there when you said financial education is the most important thing. Understanding how economy works. There's so many variables, so many things to learn, and it's a never-ending process of learning. Even Warren Buffett is still learning every single year. So I think we just got to take that into consideration and move forward and get smart people around you. Learn off others.
It reminds me, maybe that's for another video that we can make, just to talk about the money. What is money? The history of money. Understand that money eventually is a currency of trust. I think that understanding that also relates to what is going now with cryptocurrency demand, which is basically a distrust in the traditional monetary system. So I think opening up the mindset about money in general and what we see now currently, with the policymakers impacting the entire global monetary system is something that relates to that, and that can be for sure a very interesting topic to focus on.
For another time.
Yeah.
All right, Nir, thank you so much for your time, my friend. Look forward to the next one, and hope you have a good day.
Enjoy to talk with you as always. Take care, my friend.
Thank you.